We haven't really talked very much about SoFi technology so far in 2024. Let me tell you, the stock is absolutely getting pummeled down, something like 25% already. I'm Jason Hall. This is Investing Unscripted. We're going to take a closer look at SoFi. I want to talk about the one big reason for me why this is absolutely a stock investors should be buying, not selling right now. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. See it on the screen, fool.com/unscripted. Motley Fool is going to give you its 10 best stocks to buy right now. Definitely check that out. Okay, so mentioned it before. It has been brutal so far this year if you are a SoFi investor. I've got some other big bank stocks here on the screen just to put it in context. Just getting into earnings season, the mega banks reported, Bank of America's, Wells Fargo's, both of those stocks are down about 5%. SoFi is just absolutely pummeled though. It's down 25% so far this year. Now, it hasn't reported earnings. It's going to be a little while yet before it reports. Closer to the end of January, the big banks kick off earnings season. They reported last week. So what in the world is going on that has the stock down? One thing, Wall Street analysts downgraded the stock. Analysts, when they downgrade stocks, especially highly volatile stocks like SoFi's, it's not uncommon that you do get a lot of movement of the stock based on what the analyst is saying, either bullish or bearish. So we certainly saw that happen so far with SoFi. We don't have the latest results like we do with the big banks to look at their financials to try and figure out what's going on, figure out whether the market has it right in the short term or not. But we can go back and look at last quarter's results. We can see some great progress, and the trajectory was very favorable that I think is probably going to be the same thing that we're going to see going forward. I'm going to pull it up on the screen here. Let's reset the stage, talk about the business's trajectory, where it was, and think about how we can apply that going forward. So a couple of big things I want to talk about. First of all, growth. Members, this is anyone that has an account with SoFi, any of those different products that they offer. You have one of those products, you're a member. That number, it continues to grow at an incredibly rapid rate, still growing over 40% year over year every quarter. That's just incredibly impressive. Products continues to also grow at incredibly high rates, right? So people join, they get one of these services or products, add more products over time. It's a really powerful part of its strategy. Galileo, this is its fintech product. It's a payments platform that it offers for other fintech providers. Growth has certainly slowed, but it looks like it's stabilized 10% last quarter. If it can stay high single digits, low double digits, then I think this is still really important. It's a nice high margin piece of the business. But the key thing we need to focus on with SoFi is the financial services parts of its business, the banking services. And we see continued exceptional growth there. So we know the growth has been good. Let's start looking at loan products. That's really, I think, a key thing that gives us some idea of what's going on with SoFi. Okay, the text might be a little bit small on your screen, but what we're going to focus on is the lending segment. Let me blow this up a little bit, make it a little bit larger for you. Student loan originations, personal loan originations, and home loan originations. We know that going back to its core and its founding, student and personal loans are the core parts of the business. We go back to the pandemic, and it was a moratorium on federal student loan payments. As a result, SoFi's student loan originations went in the tank. The value proposition of this part of the business is being able to offer borrowers lower rates than they may have on their private or federal student loans, so they can refinance at a lower interest rate, or take the balance and stretch it out over a longer term and lower the payment, lower that monthly impact on people's income, free up disposable income. The numbers absolutely took a hit back during the pandemic, especially last year. You see the originations were significantly lower. And then what started to happen? Third quarter 2023, this was when the student loan moratorium, the payment moratorium began to expire. We started to see more and more originations happen. There's a good likelihood that the fourth quarter, we're going to see the biggest student loan origination number that SoFi has generated in multiple years, because this is really like October, November was when the big, okay, you got to make your payments. You really have to make your payments now. It's when that really started to happen. So I think we're going to see continued positive trajectory there. Personal loan originations, it's another part of the business that has started to return back to growth as interest rates have stabilized a little bit late in the year, and even potential rate cuts. Borrowers are like, okay, you know what? Let's go ahead, take out that personal loan, maybe consolidate some other debt, some credit card debt, things like that. We've seen that number continue to be good. We also saw maybe the beginning of the home loans business really start to thaw. Again, second quarter went from $90 million the first quarter, $243 million in the second quarter, almost $400 million in the third quarter. That business looks like it's starting to thaw as well. So what do we see? Continued really good trajectory on new customers coming to SoFi, those people adding more of the different products and services that SoFi offers. You look at the trends, they're really favorable across those three primary lending lines. So we see good stuff happening there. Now, let me talk about like the one reason why I think investors should be really compelled by SoFi and why it's really interesting right now. We're going to jump over to the FDIC website. I think one of the most powerful tools, if you're looking at these financial services companies, these banks, the FDIC has tons of data. And guess what? You can access it for free and it's really useful. So I want to share, like for me, the single most powerful thing about the SoFi story that makes it so compelling right now. We're still looking at that third quarter, but the point is that this is something that we see consistently from SoFi, and that is the interest rates that it earns on its lending allow it to generate an incredibly high net interest margin. Net interest margin is a critically important number for banks. 6.64% net interest margin. That's not its yield on its earning assets. That's its net interest margin. This is incredibly high. Now, you see here, it pays 3.34% on deposits. That is a very high amount that it pays on deposits. If you look at Bank of America, I'm going to use here as a comparison. Bank of America, as a comparison, pays 1.46% average on earning assets. That's a combination of deposits and other sources of cash that it has. 1.46%. So its net interest margin, 2.76%. Its total average yield of 4.22% is lower than the net interest margin that SoFi gets. Why is that important? Because it's a reminder that SoFi is built a little bit differently than other banks. It offers high yield on its online savings accounts, and it pays a yield much higher than these traditional legacy banks can come even close to paying. Yeah, there's talks about interest rates starting to fall and come down a little bit throughout 2024. Maybe that happens. Maybe the Fed decides to cut rates because the economy's cooling. They want to make sure to not starve the economy of access to capital, and they decide to start cutting rates to make sure the economy stays healthy. Maybe we see a recession, right? All of those things are possibilities. But the point is this, is that even if interest rates come down, SoFi is in a position where it can pay higher yields to depositors. The bigger banks, they're starting to see some creep. They're starting to see customers take deposits and go to the SoFis of the world, other online banks that offer higher yield, because they're tired of getting 1% or less. SoFi is built to be able to pay it because it earns such a higher yield on its deposits. If you're Bank of America, you got a bunch of mortgages that you originated that are paying a 2.5%, 3% yield. You can't pay a 3.5% yield on online savings when you've got a big book of mortgages and other loans that are generating incredibly low yields. SoFi is not encumbered by that. So that puts it in a great position to be able to continue to grow going forward, take advantage of higher interest rates to raise cash from depositors, and then take that cash and lend it out at higher interest rates, whether it's a mortgage, a student loan refinance, personal lines of credit, and personal loans that they can get, that people need access to that cash, that they can use it to consolidate other debts that are even higher interest. So the point is that SoFi is built incredibly differently. And I think that is a powerful differentiator. We've seen this big 25% sell off of the stock. Think about its market size, the market opportunity, the way that it's built for this moment, and to be able to go forward without the encumbrance that these legacy banks have with their ultra low yield mortgages and other loans they have on their books. I think SoFi is a stock investors really need to be thinking about buying on this dip.